I think we can start now. Hello, and welcome to today's webinar, Enhancing Investment Outcomes Through Sentiment-Driven Index Strategies, hosted by Index One in collaboration with BrandLoyalties. I'm Gayatri from Index One, your host for today. We're thrilled to introduce our speakers, Alexander Berg, founder and CEO of Index One, Rick Davis, chairman and CEO of BrandLoyalties, and Tony Seker, president and COO of BrandLoyalties. Sentiment data can be a valuable tool for building diverse investment portfolios, offering insights into market psychology and investor attitudes towards specific assets, sectors, and the broader market. In today's session, we will explore the fundamentals of sentiment data. We'll discuss what sentiment data is, how it's gathered, and the various methodologies used in its collection, including consumer sentiment analysis and BrandLoyalties' Luminosity metric, along with their applications in market analysis and portfolio construction. We'll have time for questions after the presentation, so please feel free to submit your questions in the chat box as they come up. Now, without further delay, let's dive in. Rick, could you kick things off by giving us an overview of what sentiment data is and how it is usually collected?
Well, sentiment data is simply what people think or what their sentiment is about either products or equities, the economy in general. And the data can be collected in a number of ways, starting with focus groups, looking at different surveys, polls. There are just an endless number of ways that you can tap into what people are thinking about. And this is different than the hardcore fundamental data that you could get off of company operating statements, balance sheets, what you can get from pure stock market statistics. So you're really tapping into the thoughts and the opinions of people one way or another. And the ways it can be collected, as I said, famously, Peter Lynch, when he was managing the Magellan Fund for Fidelity, he created focus groups and tapped into what ordinary consumers were thinking about. Other people have put together panels of market analysts and want to know what they think about the prospects are for a group of equities that each of these analysts might follow. Again, you're asking for opinions, and you're not just looking at raw numbers or filings or earnings reports, that sort of thing. We collect sentiment data a little differently than a lot of people. We're using basically a web scraping technology, but it's a very gentle web scraping. We're very conscious of making sure that we're not infringing on anybody's privacy. We're making sure that we're not doing anything on the web that will impact the providers, the information providers on the web. And that's different than some automated methodologies. Typically the automated methodologies that are downloaded to mobile devices can be very intrusive and often are not there with the permission of the people whose data you're collecting. So it needs to be collected very gently, if you will. Our methodology is a little different in that we're looking for what ordinary consumers are thinking about when they're going to purchase items, or when they're reviewing items, or when they're talking in chat groups about the the pros and cons of various products. And we do that with a methodology that is building basically a dictionary. And it's a lexicographic approach. We're building a lexicon of the words that we're encountering on the web. And we're counting the occurrences of different words that are being encountered. And we're certainly not looking at IP addresses. We're not looking at anything that could be personally identifiable with respect to the people who are submitting these opinions. And we're also not directly parsing or trying to determine whether the sentiment is a positive or a negative sentiment. We're just counting the occurrences of brand names within these discussions. How often are people talking about iPhones? How often are they talking about Android devices? How often are they talking about Hondas or Toyotas? And it's just the frequency with which brand names are mentioned that constitutes our level of sentiment data. And it's sentiment data being collected directly from consumers, not from pundits, not from talking heads, and not from analysts. So, in a sense, we feel it's rooted with the people who are driving the economy at that particular level.
Thank you, Rick. And how would you say an advisor could go about using sentiment data for market analysis and portfolio creation? And what would you say are some of their limitations?
Well, in our particular case, the data that comes from consumers can be put together into portfolios that contain consumer equities. And, that's one of the fundamental limitations. Our data is, since we're looking for consumer citations of brand names, isn't particularly useful for determining how successful a defense contractor is going to be, or a road builder is going to be, or even a home builder is going to be, or contractors of that sort. It's really good for companies whose specialties are either discretionary or consumer staples. Within that context, and that's not a small group of equities. When you're looking at the 3,000 largest equities, about 700 of them are deeply involved in that particular sector. And those consumer equities, you can come up with 500 of them that are relatively liquid, or liquid enough to that hedge funds and institutional investors would be interested in. So it ends up constricting, in a sense, the kinds of equities that you can put in your portfolios. But those constrictions are actually, from a practical standpoint, not especially problems. Our goals with building these indexes have always been to show that sentiment data can provide substantial alpha, and it can provide that alpha over long periods of time. Our data collection actually started prior to the market meltdown in 2008. And so we were able to watch that happen in real time with our data. And we saw that consumers, in fact, were coming back, and their sentiment was increasing in terms of the amount of citations, and their interest in buying things was coming back in very early 2009. And that represented to us a sign that, in fact, the bottom of the Great Recession from a market standpoint was probably over. Things were turning around, and the economy would turn around. And we were certainly seeing that data before major surveys of consumer sentiment had begun to turn up. So we thought that the data that we were publishing at that point, which was econometric data, we were looking at apparel stores, or we were looking at autos, or we were looking at broad industries, consumer industries. We felt that that data could be more granular and tied to individual equities. And that's when we began to sense that there would be a market for this data. And we were in fact supplying data to hedge funds and institutional investors beginning in early 2012. So we've been doing it for a substantial period of time, and obviously our hedge fund clients have been happy with the data, and they're finding the alpha that is in the data. The indexes that we're offering now on the Index One platform are just examples of how you can slice and dice those 500 consumer equities into different groups, ESG or broad consumer, or just consumer discretionary or consumer services. There are any number of ways that you can slice and dice the consumer sector. And it turns out that our particular methodology does generate alpha in all those cases, and the indexes are an indication of that. So that's the way that that you can put a portfolio together. And certainly we have clients, hedge fund clients, by and large, quantitative hedge fund clients, predominantly, who have used that data in ways similar to what the indexes are doing to see substantial alpha.
Thank you, Rick. And maybe you could go into what kind of sentiment data BrandLoyalties provide, and can you also expand on the BrandLoyalties indices that have been created based on this data?
The data that we have is purely consumer citations of the data. We don't look at whether it's a positive citation. To us, if somebody says I love my new Honda, or I hate my new Honda, to us they're both citations of Honda, and we are just counting the frequency of these citations. We're not trying to parse the positive or negativeness of the data. We need to have luminosity. We need to have a lot of citations. Individual regional banks or regional consumer companies that are offering services in small portions of the economy geographically just don't generate enough citations for us to make any meaningful statistics out of. We need to have cases where we're having tens of thousands of citations, new citations on a daily basis. And certainly for companies like Google or Microsoft or Apple, we're dealing with hundreds of millions of citations on a daily basis. And that gives us a robust luminosity. But it also matters whether that the citations are a sign of whether increasing or decreasing citations are a sign of increasing or decreasing revenue. And for that, you do need to follow what we call a causality chain, or confirm that there is causality between changing rates of citations and changing revenue for the corporations. And additionally, there's a second step in that causality chain where you want to make sure that the citation or the increases in revenue translate into changing equity prices? Do increases in revenue actually boost the price of an equity? And that's not always the case. There are equities who disconnect to some extent from their revenues, and that's because the prices are being driven by product announcements rather than new revenue. So we have to have both luminosity and relevance, where the data is actually driving revenue, which in turn drives equity prices. So our data it is not looking at what consumers think about equities themselves. We're not tracking, if you will, AAPL as a brand name or a keyword that we're looking for, but we are looking for iPhone. We are looking for iPad. We're looking for Mac. We're looking for words that unambiguously are related to the company Apple. We're not looking for the word Apple itself because that's ambiguous. It could refer to a record label, or it could refer to the technology company. It could also obviously refer to a fruit. So we're very careful in the brands that we're looking for to make sure that they are we're targeting product, and we are targeting words that are unambiguously associated with specific companies. So that data is provided to our clients, and we have used that data to put the indexes together that are being shown on your screen right now. This particular index that we're looking at right now, Consumer Plus Index, is looking at consumer discretionary and staples products or companies that are in those markets and listed on U.S. exchanges. So if the equities, the citation rates of the equities is increasing over the trailing quarter, we're going to overweight those equities. If they are declining, if the citation rate is declining and declining faster than peers, we'll underweight those equities. So that gives us a situation where we're doing basically rating and weighting of the portfolios based on the rate at which citations of brands are increasing or decreasing or changing over time by consumers' citations. And we can slice, for example, the ESG Plus Index is subsetting the Russell 3000 into consumer equities that in turn have positive ESG ratings. So that's that. What we have found is that doing that over the long term produces outstanding alpha from a period of 2000, the year 2000 to date, 2008 to date, and that kind of investment strategy does seem to work, and it seems to work very well. There are limitations, as I said. It works best, obviously, for consumer equities. It works best for equities that are directly involved with consumers in one way or another. Companies that are selling petroleum products or banks, typically consumers are not going to be commenting that much about them, or these kinds of companies do not necessarily engage with consumers in a way that the consumer business is really driving their bottom line, and that needs to to be factored in. So the equities that have the highest relevance to us are the ones that we want to include in our portfolios at any given time.
Thank you, Rick. And Tony, do you have any inputs on this?
Well, I think in looking at sentiment, it's important to understand the half-life of the alpha for the signals or the data that you're using. For example, if the king of Saudi Arabia dies, there's an immediate reaction to it. Whereas in data like what we're providing, there's growth in the brand name popularities that we're looking at, which trends over time. So it's not an intraday sentiment take. It's really kind of a building towards a future revenue and stock price movement. So it's important to understand that half-life. A good example, for example, is Lululemon. Maybe over 10 years ago, the chairman, at that time, the company was probably in its infancy in terms of its popularity. And of course, they were in the yoga clothing business and made these yoga pants that apparently became more transparent as women perspired in them. And the chairman made some kind of off remark about, women who didn't have the right bodies for it, maybe shouldn't wear them, or something controversial along those lines. Well, in the short term, it was kind of obviously a negative reaction to that. And if you see a spike in activity of those brand names, typically it could be negative news. And in that case, it was. However, it did draw attention to the brand. And since then, it's been a very popular brand despite some of the controversies. And as we all know, sometimes controversy sells. So you have to be aware, again, what is the short-term effect and what is the long-term effect. So if you can bifurcate that or identify what you're looking for in the data that you're going to respond to, matching it up with your own kind of trading pace, that's very important. So I just wanted to mention that.
Thank you, Tony. Well, now I'll pass it on to Alex, who can give us an insight into how the BrandLoyalties indices were constructed on Index One's index calculation platform.
Sure. Thanks, G, and thanks, Rick and Tony, for your input so far. I would say, in general, it's been very interesting to build these indices with BrandLoyalties, and I think the sentiment data that you have on offer is a very good contribution to the index space and the space of index-linked products in general. Like you, Tony, just mentioned, the data has kind of a longer-term nature to it and is typically a good reflection of long-term revenue for a company, and that I think suits itself very well to index-type products that are typically held for longer time horizons, don't maybe trade as actively or rebalance as frequently as a quant fund would do. So I think the data is very well suited for this, and as part of that, it's been very fruitful to build these different index products with you. In terms of how we've gone about it, most of these indices are blended with what you would call more traditional factors used in indices and passive products in general. So factors like value, momentum, dividend yield, and I think each of these indices provides interesting exposure or performance characteristics relative to just using those factors in isolation. So I think the sentiment sort of component is sometimes correlated, sometimes maybe inversely correlated with some of these factors, and it really provides an exposure that is different and typically outperforming the using just the classic factors. In the sort of I guess more mechanically how we worked on this and how we put it together, we received data or components and weights from BrandLoyalties, ran various iterations of back tests. So we tested out different strategies and especially parameters around rebalance frequency, how corporate actions are treated. All of these have an effect on how the index performs, how volatile it is, how much turnover is incurred. And so the indices we've now gone live with represent quite a lot of tweaking and iterations to get sort of the correct characteristics we want out of this portfolio. And once we went live with these, it's an ongoing job of maintaining the index. So our system does most of the heavy lifting, so to speak, in terms of managing things like adjustments to the portfolio, dividends, split adjustments, delistings, other corporate actions, monitoring, and then also publication. So pushing the index on our platform for interested parties to view or license, or to third-party platforms. So it's been an interesting and nice project for us, and we look forward to doing more of it in the future.
I think the platform you put together, Alex, has been outstanding in our ability to construct these particular indexes. The ability to try different slices of the economy to see which ones work best, and to try, in this particular case, we're using 3 different screening levels. We're looking at equities that we're getting a good signal for in terms of lots and lots of luminosity of citations, and then and they have a good causality chain in that the citations are translating into equity pricing movement. That's one level. And that thins down the equities. Then we're looking for the ones who are outperforming their peers in terms of citation growth over the trailing quarter. And then we do a third slice, and we can look at among those that are outperforming, are they ESG highly rated? For one slice, are they showing substantial momentum relative to their peers? Are they value stocks? Are they various growth stocks? So there are different ways that you can put different filters, if you will, on it. And the 7 equities or 7 indexes that we have running on the platform right now are basically contain those different slices. And we were only able to do that because of the ease of use of this platform in building indexes. And, from our experience, we would highly recommend it for anybody who's building indexes. And if anybody is looking for a way to use indexes for something such as direct indexing, this is a natural platform to tap into. Direct indexing using the indexes on Index One should be a piece of cake, especially since Most of the indexes are designed to contain a manageable number of equities so that direct indexing will in fact work.
Thank you, Alex, and thank you, Rick, for those words. We really appreciate it. And thank you to all of you for your valuable insights on consumer sentiment analysis and its application in portfolio construction. I'm going to now open the floor up to our audience. Please feel free to submit any questions in the chat box, and we will get back to you. In the meantime, Rick, you mentioned causality chain and the importance of it for brand citations. Can you elaborate a little bit more on that subject?
Absolutely. We're looking for equities that are luminous, and where the rate of citations on the web by consumers translates into revenue changes. That's the first step, and then where revenue changes translate into equity price movement. And you can do this quantitatively, or you can do it qualitatively, or you can do it both ways. Quantitatively, you can just run correlation analysis. You can correlate changes in citation rates to changes in revenue over, let's say, the trailing 8 quarters. And we do that with our metrics. We provide those kind of metrics to our clients. So that's the first step in the quantitative causality chain. The second step is to see if the changes in citation rates also correlate with changes in equity pricing. And as I indicated, that can be either positive or negative, or no relationship whatsoever, no correlation. And it's important that one look at it that way. Examples of equities that you might think are highly correlated or would be highly correlated are the mega cap tech companies. They have disconnected from what consumers are really saying about the equities because they become the darlings of the pundits and the research analysts. And hedge funds, for good or worse, are piling in simply because they're the hot tickets right now, and they've got all the momentum. That's not necessarily, or may not necessarily correlate to what individual consumers think about the products of those companies. There are also, you can kind of cheat a little bit and not do the thorough quantitative correlation process between citations and revenue, or citations and price movement, but you can do a qualitative analysis and say that equities in certain subsectors of the consumer industries, using GIC codes, for example, or standard industry codes. And you can tell the ones that are in sub-industries like casual dining will be highly responsive to the rate at which citations are occurring. And there are revenue changes that way, and if they're second tier in terms of their market capitalization, they're not going to be treated as the darlings of Wall Street and invested purely for the glamour value of the name. So the two qualitative ways, you can look at GIC codes and you can look at market cap as ways to determine which companies are most likely to have correlations or causality between citation rates and revenue, and if they're in the right market cap range, they're going to show responsiveness between revenue and price movement. And so the causality chain can be built either quantitatively or qualitatively or both.
Okay, thank you. And when there's a massive negative PR event that takes place and dominates the citation of a brand, how do you segregate and handle data in that instance?
There are going to be events that happen, and we'll see the Lululemon example. We'll see spikes. We'll see 4 sigma or 5 sigma events happening in the rate of citations. We'll identify those and pass that information on to our clients. We do have an event risk criteria, but we don't try to characterize that risk as whether it's positive or negative for the reasons that Tony indicated, that even the worst PR events can be positive for a company on a long-term basis. So we have, when I say we don't characterize, we don't try to parse whether a citation on the web is positive or negative. And we found that, first of all, that's extremely difficult to do. And especially with the advent of social media, where you have double negatives, triple negatives, you can have snarky comments that are almost impossible for software to reasonably parse as to whether it's positive or negative. And our experience is that the best thing to do, and the data that we have dating back to 2008, is simply a count of citations. And I think that this creates the luminosity factor, that we have to have a significant number of citations on the web for the brands of a corporation to be able to track that corporation or include them in our in the equities that we cover, creates a natural positive bias from an equity standpoint. The universe we cover happens to outperform the Russell 2000. Simply because of that positive bias that's created by our insistence that we have robust statistical number of citations for brands. So unpopular brands and unpopular companies are not going to be in our coverage, and so therefore our coverage alone creates a positive bias. And it makes it difficult, in a sense, for some of our institutional clients, our hedge funds, to create market neutral hedges from just our coverage. For the short side, they need to go outside of our of the equities that we cover. And certainly, if they're working from the indexes that we're using, they have to find something for the short side if they're looking for market neutral hedges.
Thank you, Rick. And the last question I have is, can you create any similar indices for ex-US equities?
Yes, we actually have more equities covered internationally than we have in the U.S. We've got about 3,500 U.S. equities that we cover, and between Europe and Asia, the major markets and the major exchanges in Europe and Asia, we've got about another 4,000. So we've got over 7,000 global equities, and the difficulty has to do with that causality chain from a revenue standpoint. getting revenue data and for a lot of these equities outside of the United States is tougher than getting it in the U.S. U.S. Companies have standard filing procedures, and you can go to Edgar or other sources and find whatever revenue reporting and earnings data that you could want. Doing that for equities in China or in Malaysia is far more difficult, and that's the only drawback. So that for those equities and to go when we're doing it globally, and we certainly can do global. We're relying more on the qualitative indicators for the causality chain. It's harder to do the pure quantitative analysis simply because the data is difficult to obtain or impossibly expensive to obtain. And that's one of our goals. The indexes that are currently on the Index One platform could be replicated globally, or could be replicated separately for Asia or Europe, and then global. So each one of those concepts could grow from just being U.S. to being U.S. plus Europe plus an Asian one plus a global one. And there's an ability to create equities globally if there's interest and client interest and client appetite for those kinds of ex-US markets.
Brilliant. Thank you, Rick. And we look forward to working with you on future indices as well. Perfect. Well, thank you everyone for tuning into today's webinar. If you'd like to get in touch with any of today's speakers, you can reach Alex at indexone.io and Rick and Tony at BrandLoyalties.com. You can find BrandLoyalties models on the Index One and BrandLoyalties websites. Thank you all once again for your time and participation, and we look forward to seeing you at our next webinar in the new year. Thank you, everyone.